Today, we're going to deconstruct one of the most interesting stories in Indian real estate right now, Godrej Properties. You see, it's a company that is absolutely firing on all cylinders when you look at its operations, but its financial statements, well, they seem to be telling a completely different story. So let's dive right into this growth paradox.
So here's how we're going to break it all down. First, we'll look at how they've become this new real estate hegemon. Then, we'll unpack the huge shift in their ownership economics that's really powering all this. After that, we'll tackle the accounting puzzle, which leads us straight into the bull versus bear debate. And finally, we'll look ahead at the path to fiscal year 27.
Okay, first up, the core thesis. And really, it's the story of how Godrej Properties has become what looks like an unstoppable growth machine in the Indian market, carving out a dominant position that's just impossible to ignore.
I mean, this chart really says it all. Godrej is now India's largest developer by sales. Just look at the booking value here. That's the actual value of properties they've sold. It's on track to just skyrocket from about 5,000 crores to a target of over 32,500 crores. It's clear they're just hoovering up market share from all the smaller, unorganized players.
So the big question is, how did they pull this off? How did they manage this kind of explosive growth? Well, the answer really lies in a huge, fundamental shift in their entire business model.
Now this is where it gets really interesting. Godrej has basically flipped the script. They moved away from an asset-light model, where they were kind of like project managers, to a really ownership-heavy model. Their economic interest, their skin in the game, has jumped from just 41% to a massive 93% in only 5 years. This means they get to keep almost all of the profit from their projects now.
And you might be wondering, where did the money for this aggressive land buying spree come from? Well, right here. It was a 6,000 crore rupee QIP, and with that one capital infusion, they managed to add a massive 30,000 crores in future development value. That's a 5x leverage on capital, and that right there was the fuel that lit this fire.
But you know, this incredible growth story has a counter-narrative, right? An antithesis. And this brings us to the central puzzle that confuses so many investors. It's really a story of two different books, the operational book and the accounting book.
So this slide is absolutely crucial. See that massive widening valuation gap? That top line is the soaring booking values, the actual sales that are happening on the ground. But that flatter line at the bottom, that's the recognized revenue that actually shows up on their official profit and loss statement. I mean, they're telling two completely different stories.
So why the huge disconnect? It all comes down to an accounting rule called the project completion method. Basically what it means is, even if Godrej sells an entire 1,000 crore rupee project today, that revenue doesn't actually hit their official books until the building is totally finished and they hand the keys over to the buyers, which could be years down the road.
And this huge disconnect between the real-world sales and the reported profits, well, that is the very heart of the entire debate surrounding Godrej Properties valuation. It fuels two completely valid but totally opposite arguments. So on one side, you have the bulls. They're focused on the incredible operational momentum and the cash flow. On the other side, you have the bears. They're pointing to that accounting disconnect, the stock volatility that comes with it, and the risks of actually executing on such a massive pipeline. Let's dig into the bull case first.
The argument from the bulls is pretty simple. They're saying, look past the confusing P&L statement and focus on the company's real operational heartbeat. They believe the true health of this business is measured in its sales velocity and its cash generation, not in some lagging accounting metric. And they've got the data to back it up. Check out these figures. Collections grew 40% year on year. That's solid. But even more impressive, their operating cash flow surged by a whopping 73%. This is hard evidence that all those record sales are actually turning into cold, hard cash in the bank.
And what's more, Godrej is just crushing it in the high-margin luxury segment. A project like their Godrej Trilogy sold 2,000 crores worth of property in just a few months. That kind of sales velocity shows incredible brand strength and pricing power, and that flows directly to the bottom line.
Okay, so now for the other side of the coin. The bears aren't really disputing the sales numbers. Instead, they're pointing to the very real risks that are tied to this model and, of course, the stock's pretty high valuation.
Their main worries are basically four things. One, the stock is volatile because the reported earnings can swing all over the place depending on when projects get finished. Two, construction spending is up a huge 66%, which puts immense pressure on cash flow. 3, if land prices keep rising, it could squeeze their future profit margins. And finally, the stock trades at a high PE multiple of around 38 times earnings.
So how do we reconcile these two completely different views? Well, the synthesis, the resolution to this whole paradox, really lies in looking ahead to the point where the operational reality finally crashes into the financial statements.
This chart right here is the key to the whole story. It shows the projected revenue recognition cycle. All of those massive sales they booked between 2024 and 2025 are scheduled to hit the P&L in a giant wave, starting in fiscal year 2027 and really picking up steam in 2028. This is the moment the accounting is expected to finally catch up with reality.
And what's really interesting from a technical point of view is that the stock chart shows the price is currently testing a critical long-term support trendline. This technical inflection point is happening right as the company is approaching this potentially explosive new revenue cycle. The timing is fascinating.
And all of this leaves us with the final question. With the operational engine running at full speed, and this massive backlog of sales just waiting to be officially recognized, are we simply watching a growth compounder go through its final, most critical stage of transition? The story has been written. Now, it all just comes down to execution.